Hello and welcome to this Forager International Shares Fund webinar. I'm the Chief Investment Officer here, Steve Johnson, and I'm joined in today's webinar by Chloe Stokes, Senior Analyst on the International Fund, and Harvey Migotti, who's Portfolio Manager. If you've read your March quarterly report, you will realise that it's been a very difficult financial year so far for the Forager International Shares Fund. Following on from an 80% year in the 2021 financial year, at the end of March we were down about 29% for the 2022 financial year so far, and April has been down again as we sit here and talk. If you add all of that up, we're up about 27% since the 30th of June 2021, and as much as we welcome volatility and as much as we've profited from it historically, I think we would all have welcomed a bit of a year of reprieve this year, a little bit more sleep and a little bit less stress. But we are where we are, and the market has fallen precipitously in the stocks that we own and the markets in which we fish, and that in itself is throwing up some very interesting opportunities that we are going to talk about today. I'm going to give a little bit of backdrop about what's happening out there in the market, and then Harvey and Chloe are going to come in and talk about some sectors that are showing some pretty interesting opportunities at the moment. We'll have Q&A at the end of today's webinar. Please, the Q&A panel is up on your webinar now. You can get on and start putting questions in, and we'll start sorting through them in the back end to work out which ones are most representative for us to answer at the end. So you can get cracking on that straight away. This is a slide from Baird, which is showing the percentage of stocks that have fallen from their highs by various percentages. So the couple of green lines at the top are the percentage of stocks that have fallen 40 and 50%. And you can see that half of the stocks in the NASDAQ 2000 have fallen by half from their peaks. If you look back over history, that has happened in the past for sure, but we're almost hitting a percentage now that is as high as the dot-com bubble of 2000. Perhaps more importantly or more interestingly, the red lines down at the bottom here are stocks that have fallen 70 and 80% from their peaks. And you can see that we're actually in line with the dot-com bubble and starting to reach the levels that we saw in the great financial crisis of 2008, 2009. There are a lot of stocks out there that have fallen a very long way. And as you can see on this next slide, the further you go down the market capitalization range, the further stocks have fallen by. So half of stocks in the Russell 2000, which is a US index of smaller companies, have fallen by 30% or more from their 52-week highs. If you go across to the right-hand side of this slide, if we look at stocks that are less than 2 billion in market cap, the average drawdown from peak is 44%. You go down to stocks that are less than 1 billion in market cap, and the average drawdown is 50%. And you go down to stocks that are less than 500 million in market cap, and the average stock has fallen by 58%. It has been wild out there, and we've seen a lot of that across our portfolio. Look, we don't know where the bottom is with all of this, especially in small cap stocks. It doesn't take a lot for share prices to fall even further. Someone wakes up one day, needs to liquidate a fund. We can see very, very dramatic moves. We're focused here on valuing businesses. And at the moment, we're very strongly focused on identifying stocks that we think have really good long-term prospects that we're buying for bargain prices. And we're going to talk about a few of those representative sectors today and some of the stocks that we own in them. Harvey, I'll turn over to you first, and maybe just a little bit of a backdrop as to why there is so much pessimism out there amongst investors at the moment.
Sure. Well, we've seen what the stocks have done on some of those slides, but this is a very interesting survey that I think a lot of people look at. It measures investor bullishness about the markets and the outlook, and as you can see on the bottom right-hand part of this slide, it's hit levels that we haven't really seen over the past few years, almost actually never over the last 30 years. So people are very negative on what's happening out there. I mean, part of this is because the markets have fallen, but markets have fallen because of this reason as well. So these typically represent pretty decent times to go hunting for bargains. If you turn over to the next slide, we have two more interesting charts here. This actually measures not investor sentiment, but consumer sentiment in the US. As you can see on the bottom left here, it has reached levels that we've only seen during the financial crisis and, back in the late 70s, early 80s, a period that was also marred by, high inflation and some economic woes. So consumers are very pessimistic at the moment. This has been driven by things such as inflation, higher energy, higher fuel prices. I just came back from the U.S. and there's not a single conversation where someone didn't bring up higher fuel prices or was swearing about the current situation whenever they go to the gas pump. But that's hitting things. U.S. mortgage rates have been moving higher quite dramatically over the past few months. Rising interest rates overall globally are impacting a bit of sentiment and hurting consumers' wallets. And then the financial markets obviously aren't exactly helping. You see your portfolios going down in value. You're starting to feel a bit worse about life. So that sector has definitely been hit. On the right side, really interesting survey. It's the go-to survey for smaller business confidence in the US. You can see that there's been a pretty sharp drawdown over the past few months, and it's reached levels not as bad as we saw during the financial crisis, but pretty low levels if you look through the last kind of 50 years of history that we have in this chart. So sentiment out there isn't exactly fabulous, and that's kind of been reflected in investor sentiment and obviously in share prices and so forth.
And it's changed really quickly as well, Harvey. I think, and this has been a theme of the past 2 or 3 years, where it's a COVID crisis and the whole world's going to fall apart. Oh, it's this rapid GDP recovery and everyone gets excited. And then I felt like late last year everyone was getting excited about a return to normalcy, and now we're sitting here freaking out again about how quickly everything has deteriorated.
It really looked good at one point, low rates, things growing, companies beating and raising. And then, lo and behold, a few more Omicron resulted in a few more kind of supply chain cracks, lockdowns, China's locking down again now, and then obviously the Russia crisis, which blew certain commodities out of the water, which is impacting everyone globally. You put all those things together and things changed very, very quickly from November to March, April here. It actually kind of, actually back in Feb when Russia blew up. So yeah, things change quickly, but there are reasons to be positive on the outlook, and here's why. So some of the overhang that has resulted in some of this drawdown and both consumer, small business, and investor concerns is actually abating. This is an interesting chart from Goldman Sachs. The blue line represents core inflation, particularly core inflation in the US. So you can see that it's obviously spiked to very high levels. We haven't seen these kind of levels in almost decades, outside of perhaps China in the 2000s and certain other emerging markets. But if you look at the dotted blue line, what you can see is that the rate of growth is actually already peaking and is abating as we go forward. I think Yellen just a few days ago actually said the same thing, that the Fed sees that inflation has already peaked, the growth rate at least. I mean, it doesn't mean we're not going to keep going up for the next few months or maybe even years, but we certainly won't be going up at this level. And that eases a lot of the pressure that we've seen, because it's the rapidness of how fast it actually happened that put a bit of shock into the system. So as you can see, the back end of the year is starting to look better and better. And if we turn to the next slide, left-hand side here, you can see what has contributed to inflation and the amount of basis points. If you look at those blue lines, the dark blue and the light blue, they're basically used in new car sales. That's been a decent driver of consumer inflation in many countries. We can see here in Australia, there's no cars to buy on the lots, and the same thing is happening in the US and many other parts of the world. Other things such as furniture, household goods, and so forth, same exact thing. So they've been decent drivers, but that's already peaked, and we're starting to see some of those headwinds go away. Caveat here that obviously China locking down again might cause some further disruption at this point, but generally things are getting better. If you look at the right-hand side of the chart, these are manufacturing surveys. Really interesting chart. You can just see how rapidly supplier delivery times ran up over the last couple of years, post-COVID especially. But over the last few months, we've seen significant improvements in delivery times, which means that manufacturers are getting what they need, faster and faster. Lead times are shrinking, and hence they can deliver products to consumers or other businesses at a more normalized rate. Very positive indeed, and let's hope that this continues, particularly with with China perhaps throwing a curveball into the mix, just more recently over the couple of years.
Yeah, it was only January of last year that I wrote that quarterly report cover letter saying that nobody is pricing inflation risk here in terms of stock prices and bond prices, and I'm not certain that it's going to be sustained, but there was enough to worry about at that point in time. We seem to have moved from nobody pricing it at all to everyone pricing it being permanent and it's going to stay here. And I think there are a lot of moving pieces to this, and it's a complicated picture, and we've had this dramatic change in the past 2 years over the nature of demand in the economy from services, because people couldn't buy services, to goods. That is, we're going to talk about this later in the presentation in terms of some of the sectors that we like, but also the supply chain is fixing itself to some extent, but you've also got the nature of the demand changing. So I just feel like it's a more balanced trade-off here around what here is permanent and what's not than the market is pricing now at one extreme and was also pricing at another extreme a couple of years ago.
That's 100% right.
So let's move on to some sectors then where we think there are good opportunities out there at the moment.
Sounds good. Well, we just touched upon it a few times over the last few slides, but the commodity cycle, I think we're in a very interesting period at this point, after many years of it just being a sector where you didn't necessarily have to spend a lot of time in order to outperform the market and find real attractive stocks. But this cycle looks a bit different. I've covered the space since I started Morgan Stanley M&A, doing metals and mining deals and listing companies in the markets and so forth. And it's very interesting, and things are changing rapidly, and this is driven by a few things which we'll touch upon. But if you look at the left-hand chart here, this is oil capex, the bottom line, that is. Oil capex has been going down for a good decade now, It had a bit of a small recovery a few years ago in the US due to shale, but generally it's been a downward trend. I mean, we haven't been at these low levels in, well, God knows how long. And yet, oil prices are actually looking, pretty decent, and they were okay as well a couple of years ago. So what's happened here? Well, ESG mandates are a part of it. The crash, both the oil crash in 2014-15 period and the crash we saw post the GFC has really changed producers' approach to investing capital and optimizing costs and so forth. And that's resulted in a very interesting picture where you might not necessarily get the same amount of demand destruction as you have historically in these boom and bust cycles. So you're getting a pretty nice looking environment over the next couple of years.
I would add to that investor scar tissue. I mean, I'm a perfect example, I think, of someone who's had this thesis back in 2016, if you look at that chart, that this space was underinvested in and prices had to recover, and you got whacked out of that recovery, and then the thesis again in 2019, and you got whacked by COVID again. So there are people, I think, like us generalists that have waded into this space a few times over the past 10 years, only to end up losing a lot of money, and that has, I think, compounded what's been going on a sector-wide basis where there is just no money to invest, and there's nobody that really believes these high prices are sustainable.
Sure, exactly. And I think the interesting part of what you just said, Steve, is I went to a Piper conference, an oil and gas conference in the U.S. 3 weeks ago now, and they told me that the amount of people coming has been shrinking every single year. It was great for access. I got to meet a lot of CEOs and companies and so forth. But the amount of people coming has been shrinking every year, and this is the first year that they're actually seeing a bit more generalists come in, trying to learn about the space and realizing that maybe I should be covering this. So it's, the tide is perhaps slowly turning, but that's certainly been the case. The interesting part as well that I want to mention here is that it's not just oil and gas capex. Mining capex is running at really low levels relative to GDP. I mean, we're talking about, US and Canada sitting at the lowest levels in 20 years. Global mining capex sitting at half of its share of GDP versus the early 2000s and up until the 2014 period. So you take all that together and what's actually happened. So on the left-hand side here, you can see the commodity producers' free cash flow. This stretches back a good 25 plus years, I think, the chart, but you can see that it's tripled. It's tripled during this cycle. And why is that? Disciplined capex and years of cost optimizations. It costs you a lot less to get oil out of the ground now, particularly versus the 2012, 2014 period when shale was booming the suppliers were really extracting their part of the flesh out of the equation. So free cash flow has gone through the roof. And while, the recent run-up in prices, as you said, might not be sustainable at these current levels, I mean, Russia's obviously added a bit to the stack there that, goes away eventually, when we hope sooner rather than later, and the situation gets resolved. But if you look at the real price of oil on the previous chart, adjusted for inflation, it's actually not sitting at crazy levels relative to history. But all that being said, even at lower prices, I mean, we're seeing some really attractive opportunities, and we own a couple of them in the portfolio. We bought them, I think last June. We deployed about 4% of the fund into commodities. We obviously wish we had gone even harder, but they've been good contributors and helped us during this, small cap turbulence. But if you look at the right-hand chart there, some of these companies are generating a quarter to a third of their own market capitalization in free cash flow every single year. This is obviously at these prices, but if you extrapolate a more sustained price of oil or coal or whatever commodity you want to look at, I mean, they're still looking extremely attractive relative to the broader market, and certainly relative to, unprofitable tech or whatever space you want to look at. So I think it serves a purpose in portfolios. Yeah. And as long as you're careful about picking the right stocks and understanding it's not a one-way line and one-way street, upwards, we do think that there's certainly going to be pullbacks and wobbles in both commodity prices and share prices. And we just want to be ready to take advantage of those and add to the names we like, where we have a differentiated view versus the market at those points in time.
Yeah, just on that topic, I mean, it's the one sector that has been going up, and about the only stocks, there's one other stock, but about the only stocks in our portfolio that have been going up. And I talked to the Aussie fund guys about the whole thesis here. It's a bit, well, share prices are already up and already factoring in a much more optimistic view about the future. I mean, you just touched on it there, but in terms of when and how and portfolio weighting for us, how are you thinking about that?
Yeah, so, like I said, we're sitting around 4 or 5% at the moment across a few of these names and some uranium, which we have a positive thesis on. To the extent that we feel that the free cash flows are attractive and we have the right stocks and management teams, perhaps, that feels like a good level until you get a bit of a shakeout. And I'd like to see a shakeout before adding to the space, just because things have run up. That being said, I saw a really interesting chart the other day. It was I think 40 or 50 year, the metals and mining sector in the US and Canada versus the market itself. And this is a little blip from the lows relative to the past 50 years. We're actually sitting at extreme levels still. And I do feel that even though people have started or investors have moved in the right direction, many are still underweight the space, and certainly many active managers are underweight the space. And the conference I went to a month ago tells you exactly that. No generalists have been coming there for a good 8 years, and all of a sudden they're starting to pop up because they're realizing, hey, maybe there is something exciting here. Maybe there is a bit of an interesting story. And when you put all that together with top-down ESG mandates, when I sat there with BP, and they're telling me that by 2030 they're going to reduce production of fossil fuels by 30 to 40%, and they're going to substitute that and invest it into other, kind of more sustainable, renewable methods. I mean, when you have a bunch of the large companies like BP and Exxon and Shell doing that because of top-down ESG mandates, you're going to be creating a bit of a supply problem in some shape or form, depending on the commodity. So, my
guess is there'll be some investor skittishness and fragility here. So hopefully we get some good pullbacks along the way in what's an interesting, I think, medium-term theme here. Chloe, we might move on to one that was a real darling sector 12, 18 months ago that has been absolutely smashed over the past 12 months, but where we think there are some good long-term prospects.
Definitely. So it's sports betting, and as you can see from this chart here, the stocks have been hit pretty hard. What it shows is Flutter, which is a UK listed sports betting stock, DraftKings, which is purely operating in the US, and then one that you might be familiar with if you're watching, PointsBet, which is a smaller Australian offering listed on the ASX. As you can see, these stocks are down anywhere between 40 to 70%. And they've been kind of caught up in the wider market sell-off, as have a lot of other sectors, but it doesn't help that these stocks are also, they're not overly large, They're considered more growth than value stocks, and they're also caught up in the leisure category. So when analysts are thinking about where consumers might cut spending if things start to get really tight, these stocks are caught up in that. But we actually like the sector for a couple of reasons. And one of the key ones is that the US has recently started legalization of sports betting. So that only began back in 2018. As you can see from the chart here, only around 55% of the US population live in a state where sports betting is currently legalized. 44% of the population live in a state where it's legalized and they're allowed to do it online. And then only 38% live in a state where it's legalized, they can do it online, and the operations have actually launched. So there's plenty of opportunity, one, for new states to legalize and launch sports betting, but also the states that have launched, none of them are really mature. And then on top of that, the trend here in Australia, which is quite a mature market, is that gambling spend per person still continues to increase anyway. So we think this is a phenomenal growth market. We're expecting 20 years of growth here, not just 3 or 4. And as you can see from the chart on the screen from Goldman Sachs, it's not just our view that this is a great growth market. They have online sports betting growing at around 24% per annum over the next decade, which results in the total market expanding by over 6 times.
I've sat through a lot of presentations over the years of growing TAMs and wonderful growth markets, and therefore just buy the stock, and it's never that simple. And I think the investor criticism of this space has been, well, nobody's arguing about the long-term growth trajectory of the industry, but they're all spending an absolute fortune acquiring customers, they're all losing money, and the argument is it's never actually going to be economic for the players who are spending that money. They're spending more than they're ever going to get back from their customers.
Okay, but we actually have some good evidence here in Australia and in the UK that some of these businesses, not all of them, can become really profitable once the market starts to consolidate and they don't need to spend as much money on marketing anymore. So, as I said, we've seen it play out here in Australia, and one of our holdings, Flutter, owns Sportsbet, which has operations here in Australia. They're the market leader, and I think the charts from this presentation lay it out really nicely. As you can see on the left-hand side, Sportsbet spent around $140 million on marketing in 2020, which is almost 80% more than its closest competitor. But that only represents 12% of Sportsbet's revenue. And as you can see, competitors are spending almost 16% up to above 30% of sales. So not only are sports betting able to spend more to attract and retain more customers, but they can do it more efficiently and while making much better margins. So we think that sports betting is a very exciting sector, especially in the US with legalization of gambling, but also it's an industry where the winner tends to take most.
Yeah, I've actually owned my private capacity and through our Australian Shares Fund, CentreBet and IAS Bet years and years and years ago here in Australia, and the criticisms were largely the same. Nobody's making any money, marketing costs are too high, and you look at Sportsbet today and this business is making 400 million Australian dollars a year of profit, and as you've just pointed out, it's doing that, spending more than all of the competition, yet making higher profit margins than anyone else, and that's a really, really nice flywheel that we think there's good evidence. Same thing happened in the UK, and there's actually really good early evidence that the same thing's happening in the US.
Exactly, and so we own Flutter. As I mentioned, they're a market leader in Australia and the UK, but they also own FanDuel, which is, I think, the most exciting part of the opportunity for us. FanDuel operates over in the US, and it's early days in legalization of sports betting, but FanDuel and one of its competitors, DraftKings, have a bit of an advantage over competitors because they have a history as leading fantasy sports players. So what that means is they already have an existing database of the perfect customer for sports betting that they can market to at almost no cost, while competitors are out kind of frantically searching for and marketing to those customers. So we think not only do they operate in that growing market, but they've got a bit of an advantage there in terms of competitive.
Yeah, that's really one we've got some confidence in the very long-term prospects there, and actually a space where we're interested in finding a few more opportunities as well. Let's move on. The next sector that you wanted to talk about.
So another sector that I want to talk about is the travel sector. As you can see from this chart, the European Travel Index is trading back where it was in March 2020 compared to the overall European market. And that's significantly below where it was in the prior couple of years. It's kind of tried to make a recovery over the past 2 years a couple of times there, but then we've had events like, new variants or the Russia-Ukraine conflict, and it's kind of right back where it was. So there's plenty of pessimism priced in at the moment. But we're seeing some leading indicators out of the US on earnings calls that demand is coming back for travel. The United Airlines CEO said he's never seen such a hockey stick increase in demand for both business and leisure travel in his long career. We're hearing similar things out of American Airlines and also a number of European travel businesses. So businesses are reporting increased demand, and we're also seeing it from other data. Web traffic trends are indicating that people's intention to travel is back at or above 2019 levels. We had Alphabet report recently, and they said that in the first quarter, search trends for things like travel, beach holidays are up really significantly on 2019. So there's lots of data pointing towards the fact that people want to travel.
I noticed just Visa recently as well saying card transactions for travel absolutely through the roof. So there's plenty of evidence out there that people are under pressure. There's no doubt about that, high oil prices, but they're somehow finding a way to pay for travel.
Absolutely, and we're seeing it anecdotally as well. I mean, you, Harvey, and Gareth all travelled to the US for a conference just last month. How did you find it over there?
Busy. Airports were noticeably busy, and I actually, just coming back into Australia, I was away for 6 weeks in total work, and then some time with my wife's family in South Africa, and coming back into Australia, everyone's whinging about full airports and things in a very short period of time. And Harvey, you were even having trouble booking some flights.
Yeah, I know. It was hard to find tickets, and I mean, prices have obviously moved significantly higher. People are willing to pay, as Chloe said. I mean, the really interesting part is every single domestic flight I took had a total full plane with people on standby outside. I mean, obviously that's part of that is capacity. People park the planes in deserts and so forth, and that takes time to come back online. And people have there have been some job redundancies and so forth, so you need pilots, et cetera, et cetera. However, people really, really have a lot of pent-up demand and willingness to travel. I mean, I feel it myself. I have a number of trips planned for this year.
So lots of false starts, but maybe we will see this European summer the results that we've been hoping for some time here. What do we own in this sector?
We own a couple of stocks in the sector. The first one is the business that owns Vienna Airport. So the price is kind of back down to what you could buy the business for in 2017. And I mean, it's not back to normal. March traffic is the most recent data we have. It's only around 50% of 2019 levels, but that represents a 6-fold increase from last year. So we can see the light at the end of the tunnel. One of our other holdings, Last Minute, is only around 20% below pre-COVID highs, but we think it's going to come out of the pandemic a much better business than what it went in. The most exciting part of the business is its dynamic holiday packages, which is basically when you go on the Last Minute website, you enter some dates and a destination, and it acts like a virtual travel agent, packaging up a holiday for you, often at a good discount. This part of the business, in weeks where there's not a big event happening, like a new variant or the announcement of the Russia-Ukraine conflict, this part of the business is up really significantly compared to 2019 levels. And it's also a much leaner business than what it was. Like many other companies, Last Minute was forced to cut a bunch of costs during COVID, some of those which will come back, but a lot that won't. So we're really excited about this business, and we think, absent any fresh obstacles, the recovery is already underway. And we don't just expect things to go back to normal either. With 2 years of people being stuck at home, we think there's lots of pent-up demand, and we expect travel demand to well and truly eclipse 2019 levels over the next couple of years.
Yeah, lots of worries out there. We already touched on consumer sentiment, consumer wallets being squeezed, but we're seeing plenty of evidence that wherever that reduced spending is going to come from, it's probably not going to be travel. There's just so much pent-up demand there that people are going to find a way to spend it. Harvey, we might cover this one fairly quickly because we're running a bit long here, but We do have some investments in the ad tech space that we wanted to talk about today, and it's a really interesting little ecosystem. I think back 20 years ago, you wanted to run an ad, you had 3 TV stations in Australia and you had 3 or 4 newspapers that you could put your ad in, and today we've got literally thousands of different places that you can go and place your ads and do your advertising. These companies really provide the infrastructure that allows you to do that on a wide scale. So I've got an ad that I want to run. There's 2 different, I guess, sides of it. There's technology players that collate all of the ads. There's technology players that collate all of the places that you might want to put an ad, and then they mix those things together to try and get your ad in front of the most appropriate people. And I mean, really most companies in this ecosystem fit somewhere on that spectrum of you're either serving advertisers or you're serving the people that have space and inventory for ads, and it's been a wonderful growing sector for quite some time now.
Yeah. Well, certainly it's been a very good environment for them as well, especially with the COVID lockdowns and a lot of things moving to the digital side of things. But the sector itself is, quite profitable, high margins, good growth, and it's been pretty smashed over the last, 6 months. Stocks are down between 20 and 50%. So we thought it was an interesting hunting ground, and we own 2 investments in the space that, we want to touch upon here. So the first one is Tremor. Tremor's exposed to the global connected television market. So what is this in practice? Connected televisions means that you can stream stuff through them and they're plugged into the internet. The sector has been growing really rapidly over the last couple of years, from a very low base, as you can see on the left-hand chart, and the growth outlook looks like it is set to continue. The interesting part about connected televisions is it allows an advertiser to better identify what customer they're targeting. Historically, you would say, this person likes to watch, or this is the show that's airing on TV. These are the type of people that generally watch it. Let's place these kind of ads in front of them. And everyone got the same ad. Now, people can watch the same show, but depending on other preferences, you'll get a targeted ad. And that's the beauty of it. So higher returns for the advertisers and, better, actually, quite frankly, more interesting ads for the users as well. So Tremor that we own is trading on a very attractive valuation. You can see the price to earnings chart on the right-hand side of this page. The more interesting part to us is that 30% of its market capitalization is actually cash that's sitting on its balance sheet. And on top of that, it's generating approximately 20% of its market capitalization in cash every year while growing. So attractive valuation, stock that's been smashed, exposed to an exciting secular growth area of the market. We quite like that name. Another one that's interesting is Zeta. Zeta Global operates a cloud platform that provides companies with consumer intelligence and marketing automation solutions. What does this mean in practice? Well, their platform analyzes billions of data points to try to predict consumer intent through AI and machine learning, which they've developed over a number of years. Now, a lot of companies at the moment, when it comes to advertising, are suffering from privacy changes. Cookies are disappearing, and Apple and soon Android are also, changing the privacy rules to not allow user data to be shared across advertisers. We've seen that hit certain stocks in the space, especially some of the walled gardens. Google talked about that last week, most recently. So Zeta is a bit different because through its vast network where users have opted in to give the data freely in order to use various tools that they have across the internet, including forums and message boards and so forth, they can combine all these data points to generate a single view of a consumer, encompassing their identity, profile characteristics, behaviors, and purchase intent.
What's interesting for me about this business is it's really attracting large-scale clients here. They're Fortune 500 businesses typically that are their customers. They're spending a lot of money, and what we're seeing is that the longer they stay with them, the more they're spending. I think that's a really encouraging sign that the product is working.
No, 100%. I mean, we have some data points on the page, but customers that have been with the company for less than a year generally spend around 1.7 million. Customers that have been with them for 3 years spend 1.9 million per year. I mean, that's a great sign. It means that someone that's using them starts to use them even more, maybe across other, the businesses that the company has it in and so forth. And what does that result in? Well, on the right-hand side, you can see that they've had, a very strong growth profile over the last few years that looks set to continue. And more importantly, profitable growth profile. You know, their earnings have been growing well over 40% year on year over the last couple of years. So it's been a very strong performer this year. Actually, one of the few things that's green since January. It's up around 30%. It was a busted IPO from last June that we found that halved almost because it kind of got into the wrong people's hands. We saw the opportunity. We bought it in Q4, and it's been a good performer. We still love the name. We think it's got a bright future ahead of it. So.
Yep, share price up a long way with that one, so it's probably not as clear cut as it was 6 months ago in terms of the opportunity, but a business that we want to own for a long time, which is true across a lot of the portfolio. I mean, the experience with Tremor's probably been more common. You know, we get the results, good result, great cash flow, share price down, and it's happened time and time again. There is a lot of pessimism out there in small cap land, and there's absolutely no guarantee that ends anytime soon. We think we're getting down to some, frankly, quite ridiculous valuations, but that doesn't mean valuations can't go lower. Our expertise is valuing businesses, like I touched on earlier, and we're really focused at the moment on identifying candidates that we can hold for 5 and 10 years here that can grow their business over time, where we're going to be able to buy them at a highly attractive price, but also participate in that growth. So you'll see some stocks in this portfolio that we hold for a very long time. Thanks for tuning in. We'll go to Q&A in a couple of minutes after we've had a chance to collate your questions. Please jump onto that Q&A panel and get your questions in there, and we'll be back to answer them in a moment. Queue of questions lining up here, so we'll get started. Harvey, the first is from James on this whole whether inflation is transitory or permanent, and what that means for the prospects of recession in the US and around the world into 2023. I mean, we did a session last week around consumer discretionary exposure in the portfolio, how that might fare if it's hit, and how is the whole portfolio placed for a high inflation, potentially recessionary environment?
Yeah, I mean, it's the $1 million question, right? Are we going into recession or not next year? Markets start to price it in more and more. I think I saw an investor survey that suggested, I think 50% of people surveyed expect the world to go into recession, at least the US, next year. So it's not like it's not pricing it in. You look at the UK, retail stocks are trading at recessionary levels relative to the market. So partially priced, not fully, I would say. You know, as we touch upon in the presentation, some inflationary components are here to stay. I think, you know, we spent a few minutes talking about commodities here, and we think that the setup here with supply is that prices may be stronger for longer this time with less demand destruction. Others, as we touch upon, especially supply chain issues, are abating somewhat. You know, China's a bit of a wild card, especially with the recent lockdowns, but on a 1.5 year view, some of these issues go away, and in large parts of the world, they should start going away already in the back half. You know, Volkswagen CEO came out yesterday saying that he's seeing significant improvements in supplier lead times. That was just last night. So
I still think it's a really balanced argument. I mean, I wrote that quarterly report.
Yeah.
What was at the start of 2021, saying 10-year bond rate here is 1%.
Yeah.
People are not assuming either in bond rates or in equity prices any risk of inflation being permanent.
Yeah.
And I feel like now that has shifted. You've got a 10-year bond rate in Australia of 4. The US has risen dramatically, even out at the 30-year level. And you've seen equity prices in interest rate sensitive parts of the market collapse. So I think the market has gone from we're not worried about this at all to we think it's permanent, and it's a balanced argument. And you know, I think that the nature of the demand is the other thing that has really been a huge cause of this inflation. That you've got in the US, 60% of GDP was services, and you had a massive shift from services to buying goods, and the supply of those goods is very difficult. And I think over the next 12 months, you're going to see a dramatic shift back towards travel and services related spending, and less demand for those things that are causing a lot of the inflationary trouble. So look, we don't have a crystal ball about this. We don't even pretend to. Our expertise is on valuing businesses, but we have run through the portfolio and think there is a lot priced in to the stock prices of the businesses that we own. And we're pretty confident they're going to grow over 3 to 5 years, whether we have a recession in one of those years or not. So, we're really trying to focus here on the things that we can control and the businesses that we have the most confidence in. And I think the world has become, and the market has become absolutely obsessed with macro, and it's a very, very difficult thing to forecast.
I would add that generally our portfolio companies have pretty healthy balance sheets or good cash flow generation. Some are exposed to defensive sectors such as Tesco and Celsius, things that shouldn't really shift around too much if a recession does come. We've also significantly reduced our exposure to consumer discretionary space over the past few months. I think we started trimming things 4 or 5 months ago, just to balance that out. We saw that things might get a bit pressured. So,
and some of the stocks that are exposed are trading 4 and 5 times earnings, and that was the challenge with the exercise. Is that's okay. Right. This business is going to suffer to some extent, but the market is already pricing that and has moved those prices quite dramatically.
That's right.
Chloe, we had a question from Ken, and I think this is a really good question in an environment like this in particular. Have you sold out of any loss-making holdings because you see the thesis has changed, or for any other reason?
Yeah, so the first one that comes to mind for that is definitely Boohoo. We had a pretty clear thesis on that one, which was that it would continue to grow and that margins would kind of remain in line with what they had done historically. And we started to see a couple of proof points that wasn't the case. Their UK business is still doing quite well, but they're struggling internationally, especially in the US, which is a big market for them. It was taking them 10 plus days to deliver products to consumers, which is not ideal when consumers are on there looking for a dress to wear out this weekend and then the delivery time is 10 days. It was really impacting their sales, and it's hard to say how much of that is short term versus long term. And then we also have the margin issue. Shipping costs, as for most companies, have significantly increased. They've had to charter some of their own planes. Again, that's lasting a lot longer than maybe we would have expected. And we just lost a bit of confidence around that longer term margin, coupled with the fact that there's so many opportunities out there at the moment at really interesting prices. We kind of sold out and moved on, but we're definitely keeping a close eye on that one because it has been a pretty phenomenal business.
Yeah, from some very hard-earned scar tissue, I've become adamant about winnowing the part of the portfolio where your thesis is not on track and trying to do that almost irrespective of what's happened to the price. If you wake up 2 weeks later and you've got a thesis from that point where you're at a zero weighting, where you really want to invest in this company because it's a great opportunity, great, but doing it just because the price has fallen and because you already own the stock is really, really dangerous. And there are a few stocks in the portfolio at the moment that we're in the process of winnowing, and I think the environment is very good for, okay, I can see 50, 100% upside in this stock if some of these things do prove to be temporary, but I can see 50 and 100% upside over here without needing to worry about whether it's temporary or not. Yep. And look, I think on Boohoo, a lot of questions out of this whole past few years about what the whole online retail business model looks like long term, what are sustainable earnings for a lot of those businesses. And I think, has it become dramatically more competitive because all of these old offline businesses actually had to get their act together and start competing online and have worked out that they can do it economically. And now in a lot of these spaces, you've got a more competitive online world than you had prior to COVID. So lots of moving pieces there, and I think at the smaller end of the portfolio, we're really keen on cleaning a few more things up over the coming weeks and months. We had a couple of questions here that I'll take about redemptions. Has it been a problem in the international fund with the volatility? Any consideration for the international fund to go to a lit as well to minimise any redemption or loss issues? The answer to that is no on both fronts. We haven't had a lot of redemptions. We also have a very liquid portfolio here. It's largely small caps, but a lot of those small caps being in the US, we have plenty of liquidity. A bit of a blessing in disguise. I mean, we did want to grow the size of this fund, but we didn't raise particularly significant amounts of money at the high points either. So the vast majority of people invested in the international fund have been with us for a long time. And those people who invested at the start are still 3 times their money at this point in time. So they're generally a lot more patient, loyal as customers. We're working really, really hard with those newer customers that have come on board recently to try and discourage them from doing what I think will be something silly, which is having a bad experience for the first 6 or 9 months of your investment and getting out at the worst possible time as well as getting in at an inopportune time. So that's an important thing for me personally, rather than a risk to the business, is that those small number of newer people that have come on recently stick by us and participate in the returns that we think we can make over the next 3 to 5 years. Question here, maybe you can take this one too, Harvey. What's the fund's latest PE ratio, and maybe into FY23 PE ratio as well? So sure. 22 and into 23. And I mean, it's not something we've focused on at a portfolio level recently, but we were actually discussing this a couple of days ago, and it has fallen dramatically, given the vast majority of stocks that we own here are doing what we had hoped they were doing. Yep. It's really the multiple that's crashed here rather than the earnings.
Yeah, we're the portfolio on a forward-looking basis is around 13.5 times.
So that's 22?
Yeah, well, it's blended forward, so kind of a bit of 20, a large chunk of 22 and 1/4 of 23 generally is how most of the multiples shake out. But it's slightly higher if you look at 2021. The reason for that being is we have some travel exposure, and 21 was still really, really rough, so that kind of pushes the multiple up because earnings were more compressed last year than they are this year for names such as Last Minute. And we also have a couple names that are almost doubling earnings in 22 versus 21, such as Celsius. That skews it a bit, but generally, yeah, I mean, it's a real low multiple relative to the market. You know, the S&P is at 18.5 times, even post the move down. The Nasdaq is on 23.5 last I checked. So, you know, the portfolio is taking quite a bit of a clobbering, and I think the valuation is very attractive, especially given the potential in a lot of these businesses.
Yeah, I'd say that's a good rough number to run with. Obviously, there's moving parts in there, but 13 times, the whole portfolio is trading at about 13 times this coming year's earnings, and we're pretty confident that we've got some long-term growth in that EPS over time amongst our larger positions, significant amounts of it. So it's a pretty good picture with where the opportunity set in the whole portfolio is at the moment, and you should expect to see us, I think, concentrate on the best opportunities within that portfolio, and that should help that metric over time as well. We've got a question here about just team structure, idea generation, I guess a whole wider process question, which we could really run a whole webinar on. Whenever we interact with research houses and the like, and larger financial planning groups that may want to invest with us, it's a question that we get a lot, and we're different, so I think it's often difficult for us to explain why what we do works. But maybe a quick summary from both of you on that idea generation through to how we actually invest in a stock and then manage the portfolio.
Sure. Well, as a starting point, I see part of the question here is, do we go out and do trips? The answer to that is a clear yes. I go to the US a couple of times a year, Gareth to Europe, Chloe as well, depending on, you know, what conferences are happening. Most recently, the three of us, you know, went to visit one of our investments facilities in California, Cryoport's facilities, which was, I think, amazing and really gave us a much better grasp on the business. So yes, it's definitely a really important part of I think what we do, and especially now as we're moving away from virtual. In terms of how we generate ideas, I mean, all four of us, including Steve, you know, try to pick interesting stocks to identify, dig into, to look at. That might start with a top-down view on a sector. You know, for me, that was commodities back last June when I kind of saw a lot of this shaking out, and then I looked into it and wanted to find the best bottoms-up ideas. Other times it'll just be a great stock, and you kind of, you know, try to look at the top-down as well and the end markets. But what you really love is the setup in the business, and it might be because it's a busted IPO or whatever else. I mean, generally our hunting grounds are various. You know, it could be meetings with management at conferences. We speak to a lot of, you know, brokers, and we're plugged in, especially at the mid-cap space in the US and Europe. We read a lot of investor newsletters all the time. In fact, I was up till 2 a.m. reading most recent Q1 2022 ones before. Twitter is actually not a bad source for some really off the beaten path ideas as well. Gareth has gone on some real, you know, big home runs from there. So it really does vary, but I would say it's largely bottoms up. We'll like a business, we'll like the setup. Something might have happened, busted IPO, whatever else. That's the starting point. And I think the culmination usually is, you know, a 50, 60, 70 page document, having spoken to management, spoken to industry experts, spoken to brokers, perhaps even other investors, really trying to kick the tires on where we think our view differentiates from the market itself. And then we'll always talk about that as a team, not only to try to kind of test points in the thesis, but also to see what other people think about it. Maybe they've seen something that you haven't. Fresh pair of eyes always helps. So always involve those discussions with the team, and then we will calibrate the weighting if we choose to invest in it, depending on other exposures in the portfolio. I mean, if we have let's say we have a lot of consumer discretion already, we come up with a great idea. Okay, it might be worth a big weighting, but we'd need to reduce something else. So that it is part of a bigger discussion. But generally, we'll calibrate weighting depending on some of these risk factors and how confident we are on the name delivering and the valuation and so forth. A lot of things comes into that funnel. And a kind of max weighting comes out and an initial weighting comes out of that. The initial weighting will be something we put in. And then depending on how the business tracks and whether our signals are flashing green or amber or red, i.e. based on are this thesis playing out as expected, that'll scale accordingly.
Yeah, Chloe, do you have anything to add to that? Just, I guess, starting on that, where do we look type of thing. I mean, there's a world of 38,000 listed companies out there that we could potentially invest in. How do you narrow that down to something that, is potentially going to go into our fund?
So plenty of different ways, and I think we all do it quite differently. As Harvey mentioned, like Gareth spends a lot of time on Twitter. He finds some really interesting ideas on there. Harvey's
speaking to people.
Speaking to investors,
not just random. Just to be very clear here, he
and
follows
reading
a lot of smart
investors.
Other smart investors on Twitter.
And reading investor letters. We do some screening. So often we'll be looking for particular stocks or industries where they're down significantly, and we'll just do a screen of stocks that might be down more than 50%, and we'll go through them line by line and try and figure out if any of them look really interesting. And then there's just the stocks that we all kind of know and follow, and watching all of the updates and whenever there's any huge price movements that we think might present an opportunity.
Yeah. I describe it as find, identify, value, and then wait.
Yeah.
We want to find businesses that we think we have some sort of understanding of that can give us an advantage at the right point in time. We want to identify that, we want to do the work and value it, and then we want to wait for it to trade at a price that is highly, highly attractive. And I think there's a last part of that we probably could have done better over the past 12 months in terms of waiting for things to trade at exceptionally cheap prices rather than just sort of discounts to what we thought they were worth that in that market environment we thought were large. Hindsight's a wonderful thing, but these things have fallen to prices that are extremely, extremely attractive rather than just attractive. And I think the big thing to think about if you're invested with us is we start with looking for reasons for mispricing. So instead of we're going to try and value all of those 38,000 companies, let's start with a reason why people might be getting something wrong and go and look in that particular area. So commodities, as an example, is a sector that got down to a percentage of the market that was lower than at any particular point in its history. It was down to 1% of the S&P 500 was the oil and gas sector. It was a sector that everyone had sworn off forever, including me to some extent, because there was so much scar tissue from previous forays into that space that didn't work out. So that was 6 or 7 months ago. I think you look around the world at the moment and say, okay, these high growth tech stocks have sold off 70 and 80% in a lot of situations. There has to be some businesses in there that in 5 or 10 years' time are going to be worth a lot more than they're trading at today. And the market is just selling everything, and we're seeing results come out that are good and share prices not go up on the back of it. So I think looking for that setup is what you should expect from us more than there's a particular type of business or a particular market and we only focus there. We really want to go looking for distress and then be very, very selective about the ones that we pick within that and disciplined about how we put that together in a portfolio. In terms of people, I mean, Harvey, it's you and Gareth that are constructing the weightings and the portfolio as portfolio managers there. It's my job to make sure that they're sounding those ideas out the right way, that the rationale is good and logical, and that we're putting it together in a way that doesn't take on crazy amounts of risk in terms of any one exposure. So I have overall portfolio limits that you guys work within. And Chloe, really it's your job to find great ideas and pitch them to Harvey and Gareth in a way that they're excited enough to put them into the portfolio.
And I will just mention one thing as well here. We don't try to do everything. There are sectors that we don't have a lot of expertise in, and we find difficult. I mean, chemicals would be one of them, or the more detailed parts of pharma, where we just don't feel we have an edge, and we wouldn't, I think, chase the space just because it's beaten up necessarily, to the extent there are other opportunities out there. So we do like to focus where we at least have an understanding, or feel we can get an edge, or can get an understanding of the space, which I think is important to note.
Really quick one. Anonymous says, you say the PE is 13. What was it at the fund's peak in 2021? I mean, we're down roughly 30%. So
yeah, it was
as a rough guide, I'd add 30% to that and say 17 to 18.
We were always at a discount to the broader kind of markets, especially in the US. But that discount has gotten wider.
All right, this is a genuine question, but it reads like a Dorothy Dixer, so I'll answer this one last. David says, if you really think there are bargains around, would you recommend investors investing more money in the fund? I realise this is a never ask your barber whether you need a haircut question. Look, I said this in the email I sent back out in February, I have invested more money in the fund over recent months, but I think similar to the way we think about our portfolio and portfolio weightings, you need to think about us in the same way. What is the right weighting for me in the Forager International Shares Fund? To the extent that that has fallen a lot and you think you should be at a higher weighting, then it's, I think, a very opportune time to be investing in the vehicle. But I think getting that weighting right and doing your own portfolio analysis and saying, what do I want in international shares? What do I want with Forager? What's the right weighting? And then the decision as to whether or how much more you put in comes off the back of that. I think that's an important way of getting it right. And then I know a lot of people like to spread the timing of that investment over weeks or months so that you're not sitting there trying to say, well, I've got to get the right unit price at any one particular point in time. To the extent that you want to invest more, I think it makes a lot of sense to spread that out over a few weeks or months and average your in price. We're seeing huge amounts of volatility out there. We have no idea whether that is over as of last night or not. But we're seeing, and you can see this in the unit prices, things are bouncing around 5 and 6% in a week fairly regularly. So I think spreading that investment over time makes a huge amount of sense. I'm getting waved at from behind the screen, so we might wrap things up there. If you've asked a question and we haven't answered it, we'll get back to you on email, or we'll put it up on the blog if we think it's of wider interest as well. Sorry we couldn't get to them all. Thanks for tuning in today, and we'll be back again in a few months' time with an end of financial year webinar. And don't forget our roadshow coming up as well. There's registration details coming out for that. Thanks for tuning in.